we're going to break down two different trades. So the first one we're going to look at is this RTY, and we're going to do what we call a bullish bear strategy in it. And if we're looking at this chart here, you see that the RTY is a little below its 50-day moving average, which is this bluish line here. And then let me actually bring that back up the other way. 1 second here and do that. So you got this bluish line here, and then the gold line is the 200-day moving average, and it's kind of been flat, as you guys can see, and it's way off. Well, it's not way off, but it's off its highs, and its highs were hit back in March of this year, mid-March. And so I would be this is something you can actually be neutral on. You can do something like an iron condor or a strangle or some type of skewed strangle or skewed iron condor. But I'm going to do what we call a bullish bear strategy, and it's a bullish strategy that has some short delta, and it has a built-in hedge, and we'll put that together here in a second. But we're also going to look at that same type of strategy on the NASDAQ, and you can see the NASDAQ over the last maybe 2 weeks, it's been flat, but it's been hovering around its all-time high. This is its all-time high here that it just hit a few days ago. But we're going to do a short-term trade, meaning that we're going to do something that's like 16 days expiration, expecting it to be in the trade for, let's say, tops 8 days. And unlike the Russell, this is above its 50-day moving averages. Once again, this bluish line is the 50-day moving average, and then it's way above its 200-day moving average, which is this gold line. So in this case, you could follow the trend, which I believe is going up, because that's what it's been doing, right? Going up. You can say the last couple of weeks has been somewhat flat, but it's still been hovering around its all-time highs. You can also be neutral and do something like what Jose gave us this morning on that trade idea of an iron condor with 30 days ago, and that was actually a really good trade. He's actually made some decent money on it already, because the premium came out of the options almost exactly after he got filled, because we were unable to get filled in it. So when we still have that up here, let's bring that here and just to give you kind of an example here. This is the one we were trying to get filled at. He got filled at the 16 price, and it's trading at 14.38 now. We also put this Japanese yen currency trade on. That's not going to get filled, so we're going to cancel both of these, and then we're going to get filled in something with the bullish bear strategy. So let's look at it in the RTY here. We just went over the chart there of the RTY and the NQ. Let's look at it now on the option table using the TastyWorks platform, and we're going to go with 16 days. This is normally we're trading primarily between the 30 and 60 days, and sometimes obviously we do long dated, and then sometimes we do short dated. So as little as the same day type of trade, especially when we're doing something on the trading floor. But now we're going to do a 16-day trade. It's going to be a high probability trade, but I wouldn't consider it a yellow highlighted trade. So I would consider this speculative, but if you want to follow, you can, but just keep that in mind. This is more speculative than what we normally do with our index type of trade. All right, so, and the reason why is because it's the 16-day. It's a lot more gamma risk, directional risk when you are dealing with these short-term type of trades. All right, so we have this geared up already, and the bullish bear is buying a put spread and selling a put spread simultaneously. So we're going to break this down really quickly here. On the put side, we have let me just put this here. All right, so I'm going to delete the bear part. The bullish part here, so you can see what I'm talking about first. So this is the bear part, and it's a 5-point wide spread, and the RTY, it's $50 per point. It's not like options on stock. On options on futures, you have to know the denominator of what you're doing, right? But you can do this on options on stock. You can do this on the RTY, the RUT, which is the RUT. You can do this on the IWM. You can do these type of strategies on anything, but it just has to meet the criteria. And it's just really, it easily meets the criteria when we're doing this on options on futures on these stock indexes. So that's why I'm demonstrating this. So you got the 50 times 5. 50 times 5 equals, I'm sorry, this should be a 5, equals 250. And so this is the max you can make on this spread. It's $250 minus the premium that you pay. So in this case, it's $120, give or take. So you're paying about $57 or $60 for it to buy this part. Right? And so if we go to the curve view here and we kind of bring this down, let's see if they'll show us. This is it here, right? This is, if we were just doing this would be a very low probability trade. This is the at the money. It would have to go down quite a bit before we can start winning, right? Because we're buying this around the 30 delta. So, but this is the bear part, right? This is how you make money on if it goes down. Then what we're doing is we're going to sell a put spread now, and we're going to start at the 2110. We're going to sell that. That's a 15 delta, and then we're going to buy the 2070. And we're going to buy the 2070, and we're going to break this down so that you can see just the put side now. 1 second here, so you can see just the bullish part now. You can see, so let me delete this part here so you guys can see this. And so now on this one, this is looks like it's a 30-40 point wide spread here. And what we're doing is we are selling the 2110, buying the 2070, and we're going to, and this is 40 points wide, so this is 40 times 50. Okay, so because each leg, each point is $50, so that's going to be the 40 times 50. That's going to be $2,000 max loss that you can potentially have on the put side on this, if you were just doing this spread, right? If you're just doing this, but you're receiving the 335, that's not how much you receive when you're doing options on futures. So this is, you have to know the denominator. It's only 50 points. It's not $1. So it's half of that. And so you're receiving 128, or excuse me, 168 here. And so if we were doing this, it would be a high probability trade. You have over an 85% chance of winning on this. And let me just show you how this looks. So right here, you can see this is the at the money line. If we were just doing this trade only, it would, if it went up, we'll win 100% of the time. And if it goes down, we can still win 80+% of the time, 85+% of the time. As you can see, it has to go down quite a bit and then pass this short leg here before you start losing. And then you have this built-in stop loss here on this long leg. This is the put spread. This is the beauty of the put spread. You do not have to be right directionally, and you can still be right. This is why we love this. But what we're setting up now is the bullish bear strategy. So we're going to go back and put the bear part back on, and we were buying at the 2175. This is there, and then we're selling here. So when we break this down, after it's all said and done, we get a good price on it. Unfortunately, this is starting to go up more, so we're not getting the great price that we want. So we might have to adjust this a little bit to get the price that we want, but we'll see here in a second. But in this case, you're receiving you're receiving 220, which is $50 times 220, which is actually this extrinsic here, about 108. That's how much you're going to receive for credit wise. But you have the opportunity. This is one of those rare times that when you're selling something, you can actually make more than what you sell. So you can actually make as high as $358 on this type of trade. Your max loss is the 1640. And since we're using span margin, they're only requiring us to put up 562 to be able to do this trade. So we're going to look at the curve view so you can kind of get a breakdown of this. So Now this is the at the money line. So if it goes up, because it is a bullish strategy, you're going to win 100% of the time if it goes up 100% of the time, right? But if it goes down, you can actually win more than what the credit is, right? So if it goes down, you can see that if it lands in this area between your two short strikes here, the short strike on the long put spread, which is this one here, and the short strike on the short put spread, or the bearish put spread, excuse me, the bullish put spread. So if it lands between these here, then you can actually make as much as 363 if you hold to expiration. You guys know we don't hold things to expiration, or we try not to. Nothing's 100% of the time, but it's pretty close to that for us, of not holding something to expiration. But this is a strategy that you can actually make more if it goes down, and this is a pretty big difference, right? This is a 15 point right now, 15 delta difference between these two. Sometimes we do this with an even wider, sometimes we're at the 5 delta, 30 into 5 or something, 25 delta difference. But in this case, because it's a short period of time, we have to get closer to at the money, and the Russell has jumped up now, so this is not as attractive as it was. So, but this is the one on the Russell, and if we hit review, if you're doing this on the TastyWorks platform, you have to do it in 2 trades. Unfortunately, they do not, on the options on futures, they do not support this type of strategy. So we would buy this put spread first, and then we would put on the put spread that we're selling. Okay, so we'll buy this one first. This will be 1 trade, and this to be 2. So that's how we would do it. So now let's go and look at the NASDAQ trade really quickly.
Brian?
And yes.
And is that the bullish-bear strategy that you're going over, right?
Correct.
So, okay, because I tried that. I have the same problem. So we have to put one leg first and then the other trade next, right?
Correct.
Okay.
Unfortunately, that's the way you have to do it. But it's still an excellent trade. The contest winner for the Dorian Way for July, everyone, his name is Tim Neal. We're going to have an interview later this month with him. His primary strategy is this bullish-bear strategy, and he uses the TastyWorks platform, and he has to do it in 2 trades, but it still works out. The reason why you do the buy part first, just in case you need to change your delta a little bit on the sell part to be able to get the amount you want because of a little slippage or something like that.
So the thinking behind the bullish-bear strategy is that it's going to be stagnant, or what is the analysis behind the trade?
So excellent question. So the strategy is a bullish strategy. You want it to go up, but you think that it could go down some, but not obviously a lot. But if it does go down some, you can actually make more than what you're receiving on the credit. Let me kind of break that down here one more time here. This is the trade on the NASDAQ, and this one's still down a little bit. It's not as down as it was, but this is I believe it's Veronica or Victoria. This is the at the money line, and so it's like doing a put spread and then doing a hedge, but it's all combined in the same trade, and you're basing it all on just the credit that you receive. So this is pretty clean. You got a built-in hedge that allows you to make more if it falls into this range here. This is, as you can see, this is the credit that you're receiving before fees and commissions, the 135. But if it falls anywhere in this area, and let's say you still have it on and it was expiration, then you would make $335 before fees and commissions. But we're not trying for it to do that. But if it does, then that's fine. What we wanted to do is obviously go up. Whenever you're doing a bullish strategy, you want it to go up. But in this case, you have a built-in hedge. So if it goes down, you can hold that position longer and actually make more money on it. And it's similar to like this trade that we have on here in this demonstration account here with the Russell here. We have it structured a little differently, so it's going to be hard for you to see it, but hopefully you can. I'm going to try to highlight it. This part above this line that I just drew is the bear part. This is the buying of the put. This is the selling of the put. This is the bear put spread. We did one of those, but we sold 4 of the puts though. But if it falls in between these, we can actually make more because of this bear put, but we want it to go up. And so far that's actually been playing out for us. We talked about that a little bit this morning on the call, and we've actually, it's because the Russell is jumped up since then. We're actually around $300 making the day, so it's only about a little under 1,000 left in it. This morning it was about 1,300 left. We said we wanted to make about $1,100 more in it, so we're on our way with that with 9 days ago. All right, so let's jump back over here and let's look at this NASDAQ one. This NASDAQ is giving us 135, and if we hit review, it's going to be 135, but it's not, once again, it's not telling us what it's going to be, because you can't do this strategy on the TastyWorks platform. If you're on Thinkorswim, you can do this as one trade, and hopefully in the near future, we'll be able to do this as one trade on the TastyWorks platform. I keep talking to them about it, and they keep telling me, they keep pushing out the days, the time frame, but until they get it done, we'll do it in 2 trades. So this is the NASDAQ one. The Russell one, it's a little less than that right now. So what we might have to do is adjust them both. But because the NASDAQ is down still, I want to do this bullish bear on the NASDAQ. But you can argue that the Russell has been the lagger. So it over the next couple weeks that we're going to have this on. Actually, we only want to have it on for another 8 days. Hopefully, maybe this Russell is going to outperform. So what we're going to do is put it in on both and see which one gets filled. Actually, I can't do it that way because we have to put it in. We have to put it in at 2 trades. All right, so I'm going to pick this Russell one first, and then we're going to see if we can get filled on it. All right, so I'm removing that for a second because we're going to have to adjust these strikes just a little bit. And so I'm going to go to 16 days. I'm going to go to the 30 delta here. I'm going to buy this part first, and that's going to be there. And now we're going to send this, and that's going to be $67. We're going to say it's going to cost us if we can get filled at the mid, and it doesn't look like that's going to be the case. So we're going to hit review here. We're going to hit replace order. We're going to bring up the price. Whenever you're trying to buy something and you're not taking, you have to increase your price, just like in the real world. If you're going to buy something and you don't have any takers, then you have to increase the price to kind of entice them to sell something to you. So, all right, so they sold that to us. They say it's about $70, right? So we need to get, after fees and commissions, about $170 if we want to receive at least $100 on this trade. And that's what we want to do, right? So let's go to this 15 delta here, and let's see what we want to break this down. Let's see, we got the 120, we have the 2115, and let's see if we did a 60-point wide spread. That would be the 2055. We have something there, but just disregard that. All right, so this right here is actually 475 that we will receive minus the 70. So it's 230, right? Minus the 70 that we paid. That's going to be 160. So this will actually work for us with a 60-point wide spread at 160. And we're at the 15 delta. The original trade was at the 2110. This is at the 2115. This kind of jumped up a little. Let's see what happens if we do something like that. That would be, if we can get filled, that'll be 210 minus 70. That'll be 140. I would take that. But if it's any slippage, let's say we want to get filled at 200. So you got the 200 minus the 70. That'll still be 130. So let's do this here, and let's see if we can get filled. So we're gonna send that, and they gave it to us, right? So now we have the trade on. So perfect. And when I'll show you and kind of break it down, I don't know how many RTY trades I did this today, but let's put this just in the RTY for today. That's the only ones we did. So you guys can see here, after fees and commissions, we received $155. Then we had commissions of 10, and then we had fees of 348. So after we break that down, we've made 141. That's how much we received after fees and commissions. 141. We do not have to hedge this because it's already built in. It's already had the built-in hedge. So this is a pretty nice trade. So now I want to break down. Any questions to this point, everyone? anyone. Any questions to this point?
I do. I have a question.
Okay.
What if only one of the trade gets filled and the other doesn't get filled in? What do you do then?
So you have to get the other one filled, because you buy the first one, and then you just wait till that get filled, and then after that point, you know how much you need to get for the selling of the put spread. So you, as I just demonstrated, I was checking to see how much we would get after, if we got filled at the mid, and if we didn't, I calculated how much we would, if we had to give up some, right? So if they didn't fill me at that mid price, and a lot of times they won't, then you have to say, okay, maybe I'm gonna have to give up a little, and would I still get the dollar amount that I want? And in this case, my arbitrary number was, what we consider, our basic standard trade is something that we're receiving at least $100 on.